Are you curious about what a credit crunch is and how it can impact the economy? In today's video, we're going to explore the concept of a credit crunch, its causes, and its potential effects on the financial system. We'll also dive into a recent real-life example of a banking crisis that has led to a credit crunch situation and discuss the role of central banks in managing such crises. So, grab a cup of coffee and let's get started. First, let's define a credit crunch. A credit crunch occurs when there is a sudden reduction in the availability of loans or a tightening of credit conditions, making it difficult for individuals and businesses to borrow money. This phenomenon can be triggered by a variety of factors, and we'll explore these in more detail below. Increased risk perception. Banks and other financial institutions may become more cautious about lending due to a rise in perceived risks. This can result from higher default rates on loans, economic downturns, or other events that signal potential difficulties for borrowers in repaying their debts. In response, banks may tighten their lending standards, requiring higher credit scores, larger down payments, or more stringent income documentation from potential borrowers. Regulatory changes. Regulatory authorities, such as central banks and financial regulators, can introduce new rules and requirements that affect the lending activities of banks. For example, they may increase capital requirements or impose stricter lending standards to ensure the stability of the financial system. While these measures are often implemented to promote financial stability, they can also inadvertently restrict the flow of credit, leading to a credit crunch. Sudden loss of confidence in the financial system. Events like high-profile bank failures, financial scandals, or global economic crises can lead to a sudden loss of confidence in the financial system. This can cause investors to withdraw their funds from banks, making it harder for these institutions to extend loans. In turn, banks may become more conservative in their lending practices to preserve their capital, further exacerbating the credit crunch. Market disruptions. External factors such as geopolitical tensions, natural disasters, or pandemics can cause disruptions in financial markets, leading to a decrease in the availability of credit. These events can create uncertainty and increase the perception of risk, prompting banks to tighten their lending practices. Monetary policy changes. Central banks can influence credit conditions through their monetary policy decisions, such as adjusting interest rates or implementing quantitative easing or tightening measures. For example, raising interest rates can make borrowing more expensive, leading to reduced demand for loans and potentially contributing to a credit crunch. In summary, a credit crunch can be triggered by various factors, including increased risk perception, regulatory changes, sudden loss of confidence in the financial system, market disruptions, and changes in monetary policy. These factors can interact in complex ways, causing banks to tighten their lending practices and making it more challenging for individuals and businesses to access credit. Now, let's look at the potential effects of a credit crunch on the economy. When credit becomes scarce, it can lead to a slowdown in economic growth, as businesses struggle to access the funds they need to expand, invest, or even maintain their operations. Individuals may also find it harder to get loans for homes, cars, or other purchases, which can further dampen consumer spending and economic growth. In extreme cases, a credit crunch can lead to a recession, with widespread unemployment and a decline in overall economic activity. Let's examine a recent real-life example: the collapse of Silicon Valley Bank. This high-profile bank failure triggered a deep banking crisis in the U.S., leading to a significant drop in loan demand and tightened credit conditions. As a result, smaller banks and their customers, who play a crucial role in various types of lending in the U.S. economy, found themselves in a precarious situation. The consequences of this crisis were far-reaching. With crucial funding lines becoming inaccessible to key economic segments, there was a risk of plummeting GDP and a potential recession. This ripple effect could extend to the global economy, further exacerbating the financial turmoil and potentially leading to a worldwide economic downturn. In such situations, central banks like the Federal Reserve play a crucial role in managing the crisis and preventing further damage to the economy. They can implement various measures, such as lowering interest rates, providing liquidity support to financial institutions, or even direct intervention in financial markets. These actions can help to restore confidence in the financial system and mitigate the negative effects of a credit crunch. However, central banks' actions can also have unintended consequences. For example, the Federal Reserve's quantitative tightening policy, aimed at reducing its balance sheet and normalizing interest rates, led to a decline in deposits and a tightening of liquidity in the banking system. This, in turn, contributed to the reserve constraint that played a role in triggering the recent banking crisis. In conclusion, a credit crunch is a critical financial event that can have severe consequences on both the national and global economy. By understanding the causes and effects of a credit crunch, as well as the role of central banks in managing such crises, we can better appreciate the importance of a stable and well-regulated financial system. Stay tuned for more informative videos on finance and the economy, and don't forget to like, share, and subscribe to our channel for the latest updates.